In this session, let's deal with the concept of volatility smiles. Volatility smile. Like this, we will come across some more terms called volatility frown or probably volatility skew. We will come across some of these words as a part of this chapter, but in general, we have categorized this chapter as volatility smile. It is nothing but we keep observing the term called implied volatilities. I think all of you are aware of this term implied volatility, especially when we are using the Black-Scholes formula to determine the price of an option. Instead of taking the sigma, the volatility of the underlying asset, generally we take historical volatility where we take the sigma of the underlying asset and put this sigma in the Black-Scholes formula to arrive at the option price. But instead of taking the sigma from the underlying stock, if I derive the sigma by equating the Black-Scholes option formula based stock option price, Black-Scholes formula based option price with the market option price. When I equate what should be the Black-Scholes option price for that security having that particular strike price, that particular maturity and that particular interest risk free rate of return, all else remaining constant, what should be the option price as determined by the Black-Scholes formula? I equate it with the current market price generally for the at the money kind of an option or the most liquid kind of an option, and I derive the sigma from it. We call that sigma as the implied volatility. So when we try to observe in this entire chapter, what we will be doing is we will try to observe the patterns of this implied volatility. Probably some of the most common patterns we would be observing is across the strike prices, right? For different strike prices, what is the behavior of this implied volatility? And we would also be observing the implied volatility across different times to maturity. How would this implied volatility behave with respect to strike prices? Probably for a long, for deep in the money options, deep out of the money options, at the money options, etc. And at the same time, we will also deal with long dated versus short dated options. How would the implied volatility behave with respect to that? And it also talks about different categories of options. Is there any difference between probably the currency options versus equity options? So any patterns we are trying to observe with respect to the implied volatility, we are categorizing as the volatility smiles. Alright, with that as the initial background, let's jump into this chapter. So if at all I have to determine the term called volatility smile, it's nothing but the graph that I am plotting between the strike prices and the corresponding implied volatilities. The most general thing is, see, if I try to take the different strike prices, whether of call option or a put option, I take the strike prices on x-axis and the implied volatility I take on y-axis. Right? If I get a graph something like this, means as the strike price is increasing, means a deep in the money or at the money option, or the strike price is decreasing, even the same thing, deep in the money or at the money, because if the strike price is increasing, it becomes deep in the money for call option, whereas deep out of money for put option, and it becomes the reverse when the strike price is lesser and lesser. So if I observe a kind of a shape like this, when I try to plot the implied volatility is based on the Black-Scholes option pricing formula, if I get the implied volatilities plotted and a shape of this comes up, this is what we call as a volatility smile, because it looks like a smiling. It looks like a smiling face. So that's the reason we call this as a volatility smile. But in this kind of a pattern generally is observed in currency options. Very commonly observed in currency options. We'll discuss why and what could be the reason behind it. Whereas the same graph, when I am trying to plot for equity options, it is assumed that we see a kind of a downward trending graph, downward sloping graph like this, which means as the strike price is increasing, whether it is for a call or a put, as the strike price is increasing, we see that the implied volatility keeps coming down and down. So instead of showing a smile kind of a shape like this, it shows a kind of a downward sloping, or sometimes technically it is called as smirk or even half smile, because up to here the pattern is more or less the same like a smile. So that's where sometimes we call it as a half smile or a smirk. And this kind of a shape, instead of being called as volatility smile, we call it as a volatility skew. Means what you could see is the implied volatility is higher, especially for lower strike prices, whereas it becomes lesser when the strike price increases. This is a general pattern that is seen in equity options, whereas when it comes to currency options, it looks like a perfect smile. We will see what could be the reasons behind that, and what is the general trader's perspective with respect to the volatilities in terms of currency as well as equity options as we move further. Right, this is the clear-cut definition of volatility smile and a skew, and just that the shape represents a smile or a half smile. These are the names that are associated with it. Now, one key thing that is worth understanding as a part of this session is we have already dealt with the concept of call put parity, which is a relationship like this, which is also saying that the difference between the call option premium and the put option premium is equal to the difference between the current stock price and the present value of the strike price. So this is giving us a few more insights, like here this is just a arbitrage pricing model, arbitrage free pricing model. So because of that, irrespective of the underlying distribution, even if the distribution of the asset prices is not log normal, or irrespective of the underlying distribution, this relationship should hold true. So based on this relationship, what we are saying is we are talking about the difference between the premiums of both the options should be equal to the difference between the stock price and the present value of the strike price. Now, if this is not log normal, it means whatever the distribution it is following, this relationship should hold true. So assume that this is not log normal, this is the relationship. If it is log normal, then probably I can use the Black-Scholes formula relationship. So whatever is, so the call Black-Scholes minus put Black-Scholes should be equal to S minus X by E per RT, which means irrespective of whether the distribution is following a log normal, which means Black-Scholes can be applied to it, or even if the Black-Scholes need not be applied to it, this difference will hold true, which means the difference between the call price from its corresponding Black-Scholes model price should be equal to the difference between the put price and its corresponding Black-Scholes model put price, which is also a very important relationship for us. Difference or the deviation between the market and the Black-Scholes model prices should be same for call as well as the put, which also gives us an important indication that the implied volatility will be the same for the call as well as for the put. If all else are remaining the same, the implied volatility should be the same for call as well as for the put. A very important relation, which means if at all I am trying to plot a volatility smile, I really don't need to bother whether I am taking the strike prices of a call option or a put option, because the volatility smile will remain the same for a call as well as for a put, because this relationship, the put call parity relationship, is clearly highlighting that the differences between the call and the put, whatever may be the model, whatever may be the underlying distribution, that is the difference between the two should be the same itself, which itself implies that the implied volatility should be the same for both call and the put option. Another important relationship for us as far as the implied volatility is concerned. Then moving further, we will see the patterns for a currency option versus how the implied volatility behaves with respect to a currency option. Generally, as I have highlighted earlier also, it has been observed that the currency options, the implied volatility, if the strike price is like this and implied volatility is like this, for a currency option, it is observed that the shape is more or less like this. So it's like a perfect smile, which means for deep in the money options as well as deep out of the money options, the implied volatility is much higher compared to at the money kind of option. What the prime reason is, the currency traders, they think that this deviations as well as this deviations, very large deviations on either side, have more probability. So there is a more chance of the currency exchange rate deviating either towards the downward side or towards the upward side than what the log normal distribution is predicting. If the log normal distribution is predicting that these are the limits in which the currency can exchange rate can fluctuate with X percentage, and 1 minus X percent chance that it will go beyond this and beyond this limit, the currency traders generally believe that this percentage is more than 1 minus X. So because of that, what we observe is, instead of the implied volatility being flat across for various strike prices, we see that as the option goes more and more in or out of money, we see that a curviness gets generated in the volatilities, implied volatilities graph, which is what will translate into a smile. So the prime reason why the volatility smile kind of a shape exists in case of currency options is the expectations of the currency traders that the deviations from the log normal predictions will be more and hence we see that the volatilities will be much higher towards the extreme ends, which will represent a kind of a smile. And the prime reason is exchange rate volatility generally is not constant and it keeps jumping. And one more thing that has been observed is this kind of jumps, this kind of fluctuations in the volatility are more or less addressed if we are going for long dated options compared to a short dated. So in long dated we see this volatility smile is more or less is becoming more and more flatter, whereas the short dated options, they are becoming more and more smilish. So they are going away from flat. A smile is getting very explicitly developed in case of short dated options compared to a long dated option. So these are some of the things you have to be comfortable when we are looking at the exchange rate based options, right? Similarly, now when we move to equity options, as I have highlighted earlier itself, the equity options generally follow a kind of downward sloping like this. As the strike price increases, I see that the implied volatility levels come down, which also indicates that there is an inverse relationship between the strike prices and the implied volatility. The reason is, again, the way the equity traders think is the chances of the market falling beyond what is predicted by log normal model. The chance of market falling beyond what is predicted by a log normal model is higher than the chances of going up. So for higher prices, that's where you don't see a smile as far as equity markets are concerned. But for lower strike prices, you definitely see a wide, big smile coming up when we look at the implied volatility. Right? The prime reason being the equity traders strongly believe that the probability of large downward movement compared to what is predicted by a log normal model is much higher than the probability of large upward movement. There are two prime reasons to look at it. One is called as a reason of leverage, which clearly highlights that there is a strong inverse relationship existing between the value of the firm and the volatility. The reason being, assume that if the value of the firm goes down a little bit, so automatically if the value of the firm is going down, it's an indication that the value of the equity is going down. So debt to equity ratio will go up, which is an indication of the leverage in the company going up. Leverage going up is an indication of increased riskiness, which will again result in the volatility going up, because different people will react differently to that increased riskiness of the assets. So what is clearly seen is, if the value of the firm goes down, the leverage goes up drastically, which could result in the volatility going up. And the second important reason why we see this kind of a shape is what is being termed as crashophobia by Mark Rubenstein. What he clearly came out with is Generally, the equity markets or equity traders are against the concept of heavy market crash. They have seen a couple of market crashes earlier where heavy volumes have been or heavy amounts have been lost in those transactions. So it is very clear that the markets or traders are generally against the concept of very big crashes. So to protect themselves from heavily falling prices, they don't mind a slightly higher premium for deep out of the money put option. Generally in the markets we see that the premiums for the deep out of the money put options will be slightly higher just to avoid this concept of crashophobia. And because of this, what we typically see is they assume that there is a strong notion in their minds that the probability of the market falling than expected is much higher compared to probability of the market growing than expected. So that's where what you see is this volatility skew is very significantly observed, or you find a very highly increasing volatility skew, especially in case of falling markets, whereas not that much of a skew, because when the markets start falling, all people will keep thinking of some big crash occurring. So what you find is the difference or the skew is more and more increasing, more and more significantly visible, whereas in case of growing markets you don't find the skew that much significantly observed. So that's one more important reason why we see a skewish, not a smilish kind of a behavior in case of equity options, whereas we see in case of currency options either way swings are more or less more common. And now the next thing is, till now we have been focusing on looking at the patterns of implied volatility with respect to the strike prices, whereas sometimes people use a couple of other mechanisms to compare or to look at the shapes in implied volatility. Sometimes instead of using the strike price, some other alternatives are being used. The most common form being the strike price, but sometimes instead of strike price, the strike price to stock price ratio is being used, or sometimes people also use strike price to forward price ratio, or instead of strike price even the delta of the option is being used. But for all these numbers, it's the implied volatility that is compared, and the patterns have been plotted. So these are the three other commonly used mechanisms which are replacing the strike price, and the prime reason to use these things is this is more stable in terms of the shape, and instead of the spot price, instead of the current spot price, if I take the forward price of the same security with the same maturity as that of the option, generally people look at the forward as expected value of the spot on the maturity date. Generally the forward price is equated or perceived as the expected spot price on the maturity date. So instead of taking the current spot price, probably the expected spot price can be taken, which will bring in more and more consistency in understanding the volatility smile. And if I am taking the delta of the option, I could even focus on the non-exchange traded options, which are non-American or European kind of options also. So that's the reason why people use checking out the implied volatility with respect to various other measures other than the strike price alone. All right. Then the next important thing that is worth looking for us is looking at the implied volatility, with respect to time. So probably I am taking the time on the x-axis, which is time to expiration of option, time to expiry of the option, and the implied volatility on the y-axis. If I am taking these two and plotting for, let's say, ATM options, at the money option, okay, 1 month maturity, 2 month maturity, 3 months, 6 months, 12 months, these various maturity option, and for at the money trying to find out their implied volatilities. That graph is what we call as a term structure, and that is what we call as a volatility term structure. Just like the interest rate term structure, we have used the word term structure at various scenarios also, but the concept still remains the same. For various time to expiries, if I am plotting that particular variable of interest and observing it across different times, we are calling that particular term structure, spot rate term structure, volatility term structures. All these things represent more or less the similar concept. If I am using the same for ATM option, what you typically observe is, if the short term volatilities are higher, 1 year, 1 month, 2 month options, if the implied volatilities are higher, what you will see is in the long term they exhibit a kind of a falling behavior. Whereas if the short term implied volatilities are very less, they exhibit some kind of a growing kind of a behavior. So you find the function is more and more increasing. If the short term implied volatilities are lesser, it is more and more decreasing if the short term implied volatilities are higher. So this is more and more similar to the concept of mean reverting levels of implied volatility. In case the current implied volatilities are lesser, you will find that implied volatility will keep going up in future, and vice versa, which is an indication of a mean reverting characteristic of the volatility levels itself. Instead of doing the same for ATM options, if I do for any other option, probably a deep OTM options or deep ITM options, any of them, which means combining the volatility smile with the volatility term structure, then we use the word as volatility surface. So if I am doing the same pattern not just for ATM options, but for OTM or ITM, or for that matter any kind of an option, we are calling it as the volatility surface. And what we see is the volatility surface is a very important tool in pricing options of any maturity and any strike price, because we know how the implied volatility will behave for different option levels as well as different strike prices and maturity levels. So this actually can be used, this concept of volatility term structures as well as surfaces can be very extensively used to check the consistency of the option pricing models. Whatever the option pricing model we are using, whether we are using the Black-Scholes or anything else also, we can very well check the consistency of those models using these volatility term structures as well as the surfaces. Then the other important dimension for us to look at in this context is how are the Greeks impacted because of this volatility or because of the volatility term structures. As we have already discussed earlier, Greeks are nothing but how the option price changes. How the option price changes with respect to the underlying factors. If the underlying stock price changes, I want to see how the option premium changes, we call as delta. If the underlying volatility changes and we want to see how the option price changes, we call it as vega. If the risk-free rate of return changes and I want to see how the option premium changes, we call it as rho. Like that we have been using various Greek letters to understand how the option premium changes with respect to the various underlying with respect to the factors changing, the factors which impact the price of the option changing. So we have to really understand, if at all there is a volatility smile, how would it impact these Greeks, because there is a lot of trading that is being done because of based on the Greeks. Today we have vega trading, delta trading, all these kinds of hedging and trading mechanisms which are governed based on Greek. So we need to clearly understand how they are impacted based on the underlying factors. So from that standpoint, we are using two important guidelines. Based on these two guidelines, we see the impact on the options premiums based on the implied volatility. There is one rule which talks about sticky strike rule. What it means is, this rule assumes that the options implied volatility is constant over very short period of time. So probably today versus tomorrow, or a couple of very near days, we assume that the implied volatility is constant. If the implied volatility is constant, the Greek calculation will remain constant. So as long as for a few days, if at all I am looking at the price fluctuations, option premium fluctuations for over very short periods of time, I can very well assume, because the implied volatility is constant, I can very well assume that the Greek calculations also will be remaining constant over shorter periods of time. Then we also have another rule called the sticky delta rule, which actually says the relationship between the option premium, whether it is call or put, to that of the underlying to strike price. This relationship, which means the premium multiplied by the strike price by the stock price, this relationship holds true over smaller or subsequent periods of time, which itself is an indication that the delta is already including, the formula for delta is already including the calculation for implied volatility. So because of this reason, whatever the one that is using the implied volatility, the delta that is determined through that mechanism is always higher than what is determined by your Black-Scholes model. But one thing we have to understand in this context is, whether I am talking about the sticky strike rule or a sticky delta rule, they are assuming that the volatility smile is flat for all option maturities. If the volatility smile is not flat, then we have to use the equations or functions of the implied volatility to compute the Greek. So as long as the implied volatility curve is flat in both these things, we are assuming that the implied volatility curve is flat. But if the smile starts visible very significantly, then we have to use the equation of that smile or the equation of that implied volatility function to typically compute the Greeks. And another important aspect that we need to look at in this is, how does volatility smile get impacted with price jumps. We see in case of equities, the price jumps drastically, okay, 10% in a day for a single stock, or a 5% fall within a day. So we see that the prices jump significantly in case of stock, and what we are seeing is in those kind of cases, especially when the price jumps are very high, which can come because of any significant news either on the higher positive side or on the negative side, what it is observed is the implied volatilities, instead of taking a shape like a smile, they take the shape like a frown. What it means is, if the stock price is changing drastically, at the money options will have very high implied volatilities compared to deep in the money or deep out of the money options. So this is the reason why this shape is called as a volatility frown instead of a volatility smile. So probably understanding how the implied volatility changes with the strike prices, with the time to maturities, as well as for different kinds of options, is the central thing as a part of this particular session. I hope the basic conceptual aspect of the volatility smile is clear to all of you. If you have any further queries regarding the same, you can very well get in touch with me by giving me a call on this number or sending an email at this particular address, and you can even visit our website www.pacegurus.com to get more and more updates regarding the various training and consulting programs that we do. Alright, thanks a lot for listening to this session. Thank you very much.